Welcome to Nasdaq TradeTalks, where we meet with the top thought strategists and leaders in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, and Russell Price, Chief Economist at Ameriprise Financial. We're here to discuss Fed policy and macroeconomic factors to watch for 2026. It's great to have everyone with us. Welcome to Trade Talk. Certainly two economists on the day we get the rate cut at 25 basis points. And now, looking at the post-announcement press conference, it seems to be, Russell, that inflation and labor is really where the Fed is going to be focused for 2026. Yeah,
the inflation and labor really came into this meeting as being the two primary questions. Inflation obviously rising higher in recent months, and the job market remaining pretty weak. So that was their primary question as to which one of those was the bigger risk for the economy. And I think they did the right thing in choosing the employment situation because I think that the inflation situation is likely to peak in the first quarter, subside thereafter as the tariffs anniversary, and we start to see a little bit less inflation pressure. And we should start to see a little bit better employment numbers as we head into 2026 as well.
Yeah, and the rate cut today was widely expected. Anything, based on the commentary that you found surprising, or was it relatively in line?
I think it was pretty much in line. There is a lot of signaling that we would expect that they're going to change the language to now reintroduce the phrase the extent and timing of future rate cuts to show that there's a higher bar for additional rate cuts. And really that's consistent with markets pricing, where a few weeks ago they were looking for 3 cuts next year. Now it's 2, so that already implies that we're not going to be looking at these sequential rate cuts again next year. So I think a lot of that was in line. The interesting thing was if you look at the dot plot, it's pretty wide dispersion there, so there's not a lot of agreement among the Fed, and that's what we saw with the 2 dissents for no cut, 1 dissent for 50 basis points in a cut. So there's definitely disagreement on the path ahead, and of course it's hard to make policy when we only have data through September in a lot of cases, so they're also making policy with one hand tied behind their back until we get caught up on that government data that we're missing.
Yeah, and Max, as we think about conversations that you're having with NASDAQ issuers, NASDAQ listed companies, anything you could tell us in terms of how they're interpreting it, the strength of the consumer?
I think it's really, again, it always goes back to kind of where in the stack you are. Small caps, obviously we're seeing a move in the small caps again today. We've kind of telegraphed that for years now, waiting for that inflection point. Rates are down. You're going to see the small caps start to rally and catch up to the mega caps. But again, this has kind of been telegraphed for kind of a number of years. They've kind of been in this is going to be the new normal. We're not getting back to zero interest rates. They're 3.5% now, 3.7%. So corporates are a bit higher, obviously, but I think it's been kind of standard operating procedure. Now, again, consumer, we've talked about plenty of times. It's that K-shape. Where are you in the consumer? Higher end versus the lower end. Lower end has continued to struggle, whereas higher end has really maintained their spending. Even though if they're trading down a bit, they're still kind of out there spending. Whereas the kind of lower in that sector is really not spending as much. So they're starting to struggle. They have been struggling, but again, I don't think this is really going to impact it a ton. Obviously, we're seeing debt markets getting tapped a lot more by some of the mega caps and some of the M&A that we're seeing, and a lot of the AI spend. So this will help them potentially. But again, this has been so well telegraphed. I don't think this 25 basis points is really going to have too much of an impact on anybody.
Yeah, and with the 10% that is propping up spend, it makes you wonder how much you can discern from consumer sentiment, retail sales, and so forth. If they're just going to continue to spend, I don't think it's as much of a clear picture if you look at the different demographics and also how they are spending.
Sure. So the upper end is and the middle of the income segments have obviously been doing pretty good, and lower end has been struggling more and more as they continue to struggle with things like higher health insurance costs, higher home and auto costs, and higher home electricity costs, things like that. They should get a boost, however, in the first quarter as some of the provisions of the One Big Beautiful Bill Act come into play. Particularly people at the lower end of the income spectrum will see the benefit of the no tax on tips, the no tax on overtime. Also, seniors up to certain income levels will get $6,000 tax deduction. So they should start to see a little bit better spending growth in the first part of next year.
Yeah, I mean, it is quite shocking just how much utility costs and insurance costs have come up. In many cases, 15 to 30%. I mean, it's almost impossible to expect the consumer to be able to keep to keep up with that. But to your point earlier, there's the expectation that the tariffs, as the anniversary, should help with consumer prices as well.
Yes, and we've started to see a little bit better pace of deceleration for the shelter component of the consumer price index, which is 35% of the index. So that deceleration at a little bit faster pace, I think will be prominent throughout the CPI releases that we get next year. And we could see a little bit of modest reduction in the forecast for CPI if the Supreme Court rules against the International Economic Emergency Powers Act, and that could come as soon as January.
Yeah. So you had mentioned before that we only have data since September. Are we going to get October, November, or?
Right, yes. I mean, we have a couple October data points. We just got the JOLTS data for September and October. Both came out at the same time. Next week, we should be getting the jobs data. So there's going to be catch-up coming through here, but it's just that they haven't got it. It didn't come out in time for this meeting.
Right, but the labor data that we've gotten otherwise hasn't been that ugly.
The JOLTS data, honestly, was a little bit positive in that sense, where there was a big increase in job openings, but if you look at the difference between the hires and separations numbers, which is sort of a proxy for the payrolls gains, it was about 88,000 private jobs for October, which is a pretty solid number right now, especially if you consider the break-even level of employment for the U.S., the jobs that we need to add just to keep the unemployment rate unchanged, essentially. So estimates are roughly around 30,000 right now, so that's well above that, and that would be 2 months in a row of pretty decent job gains after getting over 100,000 in the official non-farm payrolls in September. And then if the JOLTS number turns out to be right, that would be a pretty solid back-to-back numbers, a little bit of re-acceleration in the labor market after we saw a soft patch with job losses in June and August. And then if you look at survey data, there is some signs of optimism where the NFIB survey of small businesses, their hiring plans have started to pick up a little bit, and about half of people in the U.S. work for small businesses. So it's definitely encouraging to see some signs of improvement in the labor market.
It's interesting, Max, because there seems to be a dichotomy of the data that we're seeing, how the market's performing, how the economy is performing, but anecdotally, it doesn't necessarily match. I guess that's what I struggle with.
Yeah, that's been consistent. Again, it always goes back to kind of who you're asking, who's participating in these surveys, and kind of what you're feeling. You might still have your job, you're gainfully employed, but again, as costs have continued to go up, I think this new normal after the last few years where we had 20%+ inflation, calling for the end of the inflation regime is one thing, but we're not going to get deflation. Obviously, that has its own can of worms. So expecting price levels to go back to where they were, pre-COVID essentially, is not going to happen. And that new normal, it feels like, is a continuing struggle for a lot of consumers. So I doubt we're going to get that. I really don't think we're going to see deflation, see prices come back down.
Well, you hope not if we get back to zero interest rates.
That's the issue. It's how do you get those prices back down? Well, that'd be a real problem. So this is kind of that new normal, and adjusting your savings rate, your investments, the things you're able to go out and do and spend on, whether it's trips, vacations, sporting events. Those in the lower segment might not have that ability and used to, but we're not going to get back there. And that's where I think the anecdotal evidence comes from is I want my pre-COVID, inflation burst life back, and we're not going to get back there again because it's a lot of things that you really can't even control in the sense of even tariffs being taken off would impact. It's your housing. We need additional, there needs to be additional supply of housing. Energy, we see with AI now especially, the massive demand for energy, so that is not really going to come down. You're not seeing any expectations for energy demand coming down. It's only going up. So those sort of things have continued to rise in the face of the previous 20+%, 25% of inflation. So that new normal is this elevated level, and now you have to essentially accept that you have to give up certain things you might have been able to do previously if your wages haven't kept up. And that's where that anecdotal evidence, you don't feel as good because everything else is so expensive. So even though your wages have gone up, it's probably not as much as inflation did. So this is essentially the new normal. So even though it looks on the surface, the economy is still doing well, we're growing, you don't feel like you're growing as quickly. And again, it's always that the economy is not the market sort of sentiment.
Yeah, I mean, there's nothing the Fed can do about utility costs and insurance rates raising.
Right, but the one area that they obviously have the most impact as far as affordability goes is the housing market. And people are still on the sidelines waiting for mortgage rates to moderate somewhat additionally. I hope no one's waiting for rates to go back to 3%. But we should get a little bit more of that in the first half of next year. Not a lot, maybe just under 6% for a 30-year mortgage. But it does seem like the mortgage applications are doing better. And I think the housing market, existing home sales, we're still very close to that lowest level since 1995 rates. So I think there's plenty of room for improvement and to see that turnover start to improve. And next year we expect to see housing, existing home sales essentially flat when it comes to pricing, but up maybe 5 to 8% on a transaction basis.
Yeah, and that's why it's so important why what the Fed says about why they cut is critical. If we do get back to 3%, right, in the very near term, there are bigger issues under the surface besides houses being expensive.
That's right.
Yeah, and I think the common misconception, Fed is going to cut rates, mortgage rates are immediately going to come down. We've actually seen it's more of a steepening. It's the short end of the curve that's being impacted obviously directly by the Fed cuts. So you're not really seeing that same impact on the long end, which is where obviously your 10-year is going to be struck off of essentially, your mortgage is going to be struck off 10 years. So we're not seeing that same move. So there's been a lot of waiting. I get questions about it all the time. It's like, hey, are they going to cut today? I'm locking in a mortgage in a few weeks. It's like, well, yeah, it's already priced in, number one. Number two, you're not going to see the same impact on the long end versus the short end of the curve. So you're not, just because they're cutting 25 basis points, don't expect mortgage rates to fall 25 basis points. And it felt like there's been a lot of waiting for rates because we were in that sub 3% environment for a long time. We're kind of waiting to get back there, and I just doubt we're going to get there. Maybe under 6%. If we get back to 5%, that might be the kind of new baseline of, hey, this is a good rate to lock in here. Yeah. Don't try to wait too long or try to game it to try to get something better.
Because it's interesting. I mean, houses are on the market for almost 55, 60 days, at least in the area where we live. They were going even before they were listed during COVID. Yeah.
Well, I think one thing to also consider this time around is because everyone, they're buying homes, they're refinancing during COVID, the rate cuts, even to the extent that they do bring the mortgage rate down, it's not going to be as big of a boost to the consumer because just not a lot of people are going to be able to refinance profitably currently. So that kind of channel for the Fed to support the consumer this time around isn't there as much. So we're not going to get as much of a lift there. Of course, at the same time, we do have the tax cuts from the One Big Beautiful Bill Act, which might kind of offset that usual mechanism for helping out the consumer compared to previous rate cut cycles where you consider a more normal mortgage market in and around those rate cut cycles, where then when people are refinancing more broadly, you might get a bigger boost to consumer monthly income flows and stuff like that.
Yeah, I mean, that's a great point. If you're sub 4%, it doesn't make any sense unless you have to move, right?
But that could also be a factor why we avoided that recession in 2022, 2023 that everyone was looking for, right? There was that a huge chunk of household debt was really insulated from those rate hike cycle that we saw back then.
And even if you make the argument from a historical perspective, we are on the low end of the range. It's just the cost of everything doesn't mitigate that, right?
That's right. In fact, and the Fed is still above what they consider their neutral rate. So if we do get further deceleration in inflation in the first quarter, we have a few more months where it's likely to go up before we get there. But if we do see the deceleration in inflation, I think there's plenty of room for further cuts. Before we get to that neutral rate, we probably have about another 75 basis points or so. Really the biggest risk that we see too, the outlook for 2026 is still the job market. And I think the evidence shows that most of the impact on jobs has been because of the tariffs, primarily small businesses having difficulty with that further challenge of having to deal with all the paperwork and everything else involved with the tariffs. So small businesses, if they stabilize, they get more used to dealing with the tariff situation, and we get a little bit further cuts from the Fed, that should enable the job market to stabilize and start to gain traction once again.
Yeah, and that's what you said with the JOLTS report, that small business, based on their hiring numbers, looked quite positive.
Right.
Which could be reflective of your thesis.
Right.
Yeah, the NFIB survey.
Or NFIB, sorry.
They have a hiring plans question in there, and so that's been improving a little bit lately, which is definitely an optimistic sign. And it does track pretty well with private payrolls in the U.S.
We've also spoken to, Michael, that perhaps we didn't see a surge of hiring as it relates to the AI cycle because perhaps companies don't know what they have to hire for yet.
Right.
And so, I mean, if that comes back on track and they're understanding, okay, these are the use cases, this is the type of skill set that I need to hire for, that could also add a boost.
Sure.
I'm not sure, that's anecdotal more than
Right.
supported by data, but.
Eventually, we will start to see some job cuts because of AI, because of the productivity boost. Of course, we saw that in October when Amazon announced 14,000 job cuts. They targeted middle management with that, mentioning AI. But I think that's going to be longer and much more drawn out. The stall that we've seen in hiring over the last couple of months, really, I think the evidence shows is related to tariffs. In other words, it should bounce back once tariffs become the norm and we start to anniversary those implementation dates. So I think the outlook is good, but with a big uncertainty associated with it. But if we don't quite get there, there is room for the Fed to kind of come to the rescue.
Sounds like a good scenario as you look into 2026. Appreciate everyone's insight. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.